Hello, Brian Ladd from Cascade Sotheby's Realty here. I appreciate you guys taking some time today to join us for our November real estate market update. It's been an interesting couple months. Actually, it's been an interesting year, and we've got a lot to go over. So it looks like we just went live here, and we've got a few people joining us. So I'm just going to give it one or two more minutes to make sure that everyone can join us. And we've got a couple different ways to interact today. I'm going to try to keep this very short and succinct. I want to honor everyone's time. So if you have any questions, we've got a chat function. We have someone monitoring that. And then also we're going to do these polls like the one that we just popped up here regarding COVID. And I'd love to see your responses on that. I think I'd like to make this as interactive as possible. So the first one we just posted here about COVID and what type of impact it's had on you. It's interesting seeing some of the results come in already. It looks like for the majority of you, COVID, you're stating that has not, we'll post the results here in a second, have not affected your housing goals, with a few people saying it's negatively impacted you just because of prices going up, whatnot. And then a few are actually saying, we got one here that's saying it's positively affected me. It's allowed me to move to Bend with remote work, things like that. So interesting. We'll post those here in a second. But I'm going to go ahead and get going today. We've got a lot to go over, and I think I can get this done in about 15 minutes. So if you have any questions, send us those questions as soon as you can, but I'll get going. So, in summary, Bend has had a wild ride this year, and housing has been a big part of what's happened here. Housing has been has been largely affected by what's happening here in Bend this year. All parts of the economy have been dramatically affected. And it's a far from a normal market. And I've been able to kind of break it down in my mind for lack of a better delineation as kind of pre and post COVID. So before we get too into the details of kind of where we stand now, I think let's just spend one or two moments talking about kind of where we were Q1 before all this happened. So if we look at the top chart here, this shows average sales price. Every year there is an ebb and a flow in pricing. There's usually about an 8% delta between the peak and trough pricing of every year. And what this shows is that in April of 2020, prices were up about 9.5% year over year, which was quite strong. And it was following its traditionally season rise, with that trough usually in November, December, starting to build up throughout the spring. One of the other noticeable things that we have on the bottom graph here is the inventory level. That is a graph that we have it measured in months, which shows that in April of 2020, we were at 4.7 months of inventory, which means that if no new homes were to have come on the market, we would have sold through all the houses. The market had nothing for sale in 4.7 months. 6 months is a pretty balanced market. And over the last number of years, it's kind of ebbed and flowed above that line, above and below that line throughout the year. And that was down 15% year over year. And what that means is that the market was strong. The buyers were buying all the homes that were on there, and then we were actually seeing a decreasing amount of homes for sale. Both of these data points really demonstrated that the market was strong, it had support, and was really pointing towards future price appreciation, but nothing wild, nothing out of the ordinary. But then COVID happened, and I started calling it, a great disruptor. But I think a more proper term, when looking at it from an economic standpoint, especially housing, is to call it the great accelerator rather than the great disruptor. And I do want to take one moment here and state that we're going to simply be talking about COVID today in the terms of real estate. The true and horrible health effects that this has had on people and their jobs and all that is heartbreaking, and we have a long way to dig out of this hole together as a community. But I'm not trying to be tone deaf, but I'm going to be simply speaking today about COVID in the terms of how it's affected housing and real estate here in Bend, Oregon. So there's this one quote that I put here, and I think it really speaks to how I feel about it. And I said that I think it is on us in the real estate industry to rethink our industry and our town in this post-COVID world. And there's this quote that I've heard before, that snow melts from the edges. It's subtle until it's gone. And what has really happened is, while we've noticed the changing demographics and work habits and housing needs for years in Bend as people have moved here from urban centers, I believe that COVID was really an inflection point that made it blatantly obvious that the present and future of Bend have shifted in a big way, and it's happened quickly. So let's talk about what happened with COVID and how it affected Bend. So let's go back. The chart that I just put up here are the initial claims. This is the weekly initial claims for unemployment in the state of Oregon. Traditionally, for the last number of years, we've always averaged about 4,000 or 5,000 unemployment claims per week. One unemployment claim is too many, but it was about 4,000 to 5,000 on average. But then, as you can see, that line just goes absolutely straight up in April. And we went from about 5,000 claims a week to 70,000. And our unemployment rate went from, and I think it was about 4 or 5% in Oregon, went up to 15%. So we saw 14x in unemployment claims in less than 2 or 3 weeks. And it was an absolute shock to the system. And then let's talk about sales. So what this shows is about 1.5 years of pending sales, and sales dropped. So sales dropped by about a third. They came down 37%, and they started trending down in April and May in a season that's traditionally rising. So it was very noticeable. And it was very, it was starting to impact all parts of the economy, and housing was very quiet. Our showings were down by about 60 or 70%. And, the word on the street was very pessimistic. I had people approach me saying, Brian, this is 2008 all over again. I was speaking with a real estate agent that says, hey, I don't have enough confidence to have my buyer buy a house right now. I feel that, this is the bridge to nowhere, and it would be bad for them. I heard people say housing is going to crash. I heard other people say, I will wait until the prices come down. But this data simply didn't support that pessimism. In times of insecurity, it's easy to get emotional and go back to our kind of most recent, history with this. What do we know inherently? But when I looked at the data and tried to take the emotion of the headlines out of it, it simply didn't support a crash. And we were pretty vocal as a group talking about how we didn't see a crash. And there was a lot of people that were kind of distrustful of that for a little bit. But as it's played out, it's pretty much played out the way we talked about it. What I have here is a graph this is the Case-Shiller index for national home prices back to the mid 80s. And those gray lines there that are vertical are recessions. So it shows our past 3 recessions, and then on the far right is shown in yellow, which is our current recession, because we are in a recession right now. But this is what we talked about in the spring, in April, May, June, of saying, hey, housing isn't necessarily correlated to a recession. And what was interesting for a lot of people to find is that in the 3 of the last 5 recessions, housing prices actually went up. One went flat. And only one of the last 5 recessions had a correction or a measurable correction in housing prices during that recession. And it just so happens to be that was 2008. And that's the one that's fresh in everyone's mind. But that was an anomaly for so many reasons. We had an incredible amount of speculation in the market. We were over leveraged. We had horrible lending practices. The recession was actually tied to housing that time because of mortgage-backed securities, and it was really an anomaly in history. But what we remember is the big crash. Not only was the economy bad, but housing went down with it. And I think it was a natural reaction that everyone had, that, oh God, this is feeling weird. It's all going to happen again. So we went to the data. We went to big, large financial institutions, and everything that we could find, from Goldman Sachs to JP Morgan, Morgan Stanley, they were all saying the same thing, that this economic disruption, this everything that was hitting was going to be relatively short in nature. And then there was a lot of fiscal policies by the government, agree with them or not, there was a lot of stimulus and a lot of money put into the economy. And they all felt that, the economic effects would be rather short-lived and it would come back pretty quickly. Now, as a small aside, I do believe that there's been different people in different socioeconomic stratus in our economy have reacted differently. I think the wealthy have overly benefited from this recovery in the sense that the stimulus has driven up asset class values and the stock market, and their jobs are less affected by COVID than people in the service industry, that their jobs were greatly, affected by this COVID. So there's a lot of people talking it's a little bit more of a K-shaped recovery where a portion of the economy is coming roaring back, and then there's a portion that's left behind. We can talk about that a little bit more later, and my heart goes out, but let's just talk about real estate. So we definitely saw that coming back. What's also we saw happen with COVID was a new trend. We saw an increase in people moving out of the urban centers, and we saw a strong migration trend start nationwide from urban to rural areas. Some of these headlines, help underscore that. People moving out of the cities, coming to lifestyle, less dense areas all across the nation. So we're seeing this from downtown cores, whether it be New York, Seattle, San Francisco, where condo projects are at 20-25% vacancy, the rent rates are falling. But even in those cities, those suburbs now are booming. And then lifestyle towns like Bend and Boise and Bozeman and all those usual suspects here, especially in the Northwest, are really getting the brunt of that migration trend. So then let's talk a little bit about unemployment, how we've recovered. So we were just looking at that graph a couple slides ago where unemployment absolutely went through the roof. But if we look at it, it's come down almost equally as fast. And so I'm not saying that we're where we should be. We're still showing about 8% unemployment here in Bend, this is the state of Oregon, but we're down almost about where we were pre-COVID. So we have a long way to go, but we're well on our way. I'm going to take a quick aside here and just mention one thing. I'm lucky to participate in, there's an impact conference happening here in Bend next week. It's going to be it's a 2-day conference. We're going to both have a couple in-person events at a few different centers. This is hosted by the Chamber of Commerce, and I cannot wait to partake in this, but more importantly, to learn from all the great people that are going to be part of this. They're bringing in nationally renowned speakers. They've got some people from the head of the National Association of Realtors talking about how housing has changed in general and how it serves the people and migration trends. And we have people from the lending industry and the commercial real estate industry joining us. And we've got some panels for discussion, and I cannot implore anyone enough to join us for that. So we put the notes on how to join and sign up for that. There's a few in-person options to join, and then we've also got quite a few virtual options as well. So it's a 2-day conference. I believe each day is about a half a day. It's kind of an 8 to noon type of thing next Wednesday and Thursday. And I really invite you to go to that. If any of this is interesting to you, I think that the conference is spot on for you. But to get back to this, what else did we see? Let's talk about housing prices. So housing prices absolutely blew up. We saw sales prices, they're up about 17% year over year. And now Bend's not alone in this. We can't say that Bend, is the only one to experience this. The small metro areas like ours across the West, the less dense small metro areas are all seeing similar sorts of patterns and behavior. The other thing is we sold through our inventory. So, we kind of have that annual ebb and flow, and it started falling in the spring, and it's absolutely fallen off of a cliff. So we currently stand, our inventory is down about 60% year over year. That's at about 2.9 months of inventory, which means we have about 80 days or so of inventory in the market, which is far below what we need to have a normal balanced market. Now, the other thing that is a little misleading in that there's still a few homes out there that are overpriced, that have been on the market for a while. They need to do upgrades, whatnot, to really to sell. And the number of days on the market for homes that are actually selling is 5. 5 days. So if anyone is a buyer trying to buy in this market, you know what I'm talking about, that the home you want is gone tomorrow as soon, as soon as it comes on the market. You need to be extremely competitive and well prepared if you're trying to be a buyer in this market. Now, what I'm going to do the next couple of slides is try to predict some of the reactions that people may have when hearing this information and or what I'm hearing on the streets. Now, a lot of people are saying, well, who cares what's happening in the market? We recovered, right? And this is another bubble. I'm going to challenge that belief a little bit because I have to challenge myself. I'm definitely not an eternal optimist and naively saying that every asset class in housing always goes up. But what I'm studying is like we were contrarian this spring. I'm also a little bit contrarian on that right now. And there's a lot of good data and a lot of economists supporting that. We need to look at housing affordability through a bigger, wider lens. We also need to look at through the lens of affordability, monthly payments, things like that. And this effect of what the effect that we're getting right now from mortgage rates is absolutely incredible. Frankly, I see it as a subsidy to buyers across the nation right now. And it's really helping offset some of these increases that we've had in housing prices. Because when people think of a house, they're saying, okay, I'm going to buy a $400,000 house. Most people don't buy a house at once unless they're a cash buyer. When you're buying a house, you're buying it over 10, 20, 30 years. And when you actually look at the cost of the interest, it can be 2 to 3x the purchase price. A $300,000 loan may have $5,000 or $6,000 of interest over 30 years. And so when we're looking at interest rates that are now below 3%, which is absolutely insane, what it does is it helps offset that. And if we look at this chart on the left here on housing affordability, that graph, the higher is the better for the buyers. It actually shows that in real terms, homes are more affordable to buy now than they were in the 90s, 80s. The only time that it was better to buy was in that 2011, 12, 13, 14, which was a time of the market where we had a lot of foreclosures that hit the market that came out of that 2008, 2009 crash. So in historical terms, this interest rate has really been kind of a subsidy for buyers and has really kind of made it a little bit of a head scratcher for people, because even though the prices are going up, in relative terms, it's actually somewhat more affordable to buy. The caveat to all this is what happens over the next couple of years as interest rates goes up. We could do a whole seminar on that, but what I'm seeing is that from the experts in the industry is they predict that interest rates are going to be relatively stable for about 2 years. And really housing is going to benefit from that across the board because our economy still has soft spots in it. The government is trying to, keep the economy going, and they're really using housing as an asset class to kind of lead us out of the recession. So the 2008 recession, housing was the cause of it. Really, housing is going to carry us out of this recession because what's happening is as they keep these interest rates low and housing is performing well, it makes house purchasing more affordable. And I also see it as kind of an insurance policy. Whether house prices go up or down in 3 or 5 or 10 years, when you're buying for the long term with lower interest rate, it can really, it's kind of it helps offset some of that risk. So, and the other thing is that virtually all economists are now calling for positive price appreciation next year. National Association of Realtors is calling for price appreciation just under 5%, Zillow 7%, and those are nationwide terms. And in pockets like ours, usually it's a bit stronger than even that. So what we're not seeing are the experts fearing, price depreciations for 2021. Now, the other thing that people are hearing is saying, Brian, you're overly optimistic. I heard there's a lot of foreclosures coming because people are in forbearance. Now, without getting too into the weeds on this, I just want to address what foreclosures and forbearance are. When COVID hit, the government was smart enough to understand that we can't do what we did in 2009 or 2008 and put our head in the sand and let everyone get foreclosed on. We need to put a timeout. And part of the CARES Act was to allow people that were affected by COVID financially, otherwise, where they could put a 180-day delay on paying their mortgage. And a lot of people took advantage of that. And then at the end of the first 180 days, you can actually delay it for another 180 days. These are things you definitely need to talk with your lender about, but it basically gave people a year of not having to pay their mortgage. So when people have an option not to pay their mortgage and then there's not even penalties on it, and a lot of the times they can just throw it on the end of their mortgage term in 10 or 20 or 30 years, A lot of people took advantage of that. So at one point, we had about 10% of the mortgages in the US here a couple months ago in forbearance. And there's a lot of economists out there that aren't familiar with the housing industry, and they said, haha, that's going to be the cause of the next recession. Housing's going down. But what they didn't realize is that there was no real penalty to do this. Why not do it? And as we got near the end of the forbearance period of starting to have to work it out or come up with a plan with your lender, those numbers started falling dramatically. And as you can see on the poll here on the left, what we've seen is that at one point we were over 5 million homes in forbearance. We're now down to about 3 million. The other part of this is that unlike 2008, where housing prices were falling, people have a lot of equity in their homes. So in 2008, people were buying home, let's say in 2007, someone bought a house with 10% down, housing prices went down 10 or 20%. They owe more in the house than it's worth. They're throwing the keys to the bank and saying, I'm gone. It's a completely flipped equation now. People have equity. We've been in a rising market. It looks to be continued to be a rising market in the near, short, and mid future. And there's no reason for that. And so what's happening is that anyone that is getting, if they truly are having problems paying their mortgage, more likely than not, they have positive equity. The chart here on the right shows that about 60% of Americans have 30% or more equity in the home, and there's only 10% of Americans that have less than 10%. So 9 out of 10 Americans have over 10% equity in their home, which means if they're behind in payments, they're no dummies. They're going to put it on the market. It's a strong market. They're going to sell it. They're going to get some money in their pocket, and they're going to then sell the house and pay off the mortgage. So it's just a very, very different situation than what we had 12 years ago. The chart here on the left, and I'll get off this in a second, shows that what's been happening in the last number of months, the number of homes in forbearance from all the different people that underwrite the mortgages, we're at about 7% and falling right now. And while I'm not going to say it in as strong a terms because I'm not binary on predictions, but Ivy Zellman, who's an incredibly respected economist, she said the likelihood of us having a foreclosure crisis is about 0%. And so I think anyone that's been pointing to the forbearances as a reason that we're going to have housing issues in the next year or two, I think need to take a deep breath and get a little bit deeper into the data before we have a deep conversation about that. So, what I want to get to is we don't know everything, but we're in a very strong position, and we need to get down to the data to understand what's happening. So we don't know everything. What do we not know? What we don't know is if the city flight and these remote working trends will continue post-COVID. Once we have a vaccine, once employers say, hey, I'm just not enjoying having my employees spread out over 6 states and all these different towns. I want them to come back. How will that affect things? How strong will those trends be? We also don't know the permanency of the new Bend citizens. I say this with a wink here. Will a big winter affect their perception? When the snow starts piling up this winter, how will it affect all these people that moved here? That have spent their first couple months tubing down the river and walking our sunny trails. So I say that in jest, but it does get to a bigger thing, that are the people that have moved to these smaller metro areas and lifestyle towns here for the long term. So I have some belief on that, but that's not definitive. The other thing is, are higher prices are higher prices in our market going to bring additional sellers and inventory to the market? So what that means is there's been a lot of people sitting on the sidelines this year not wanting to sell, but now the prices are where they're at. And now that people are more comfortable with COVID and having to sell, as 2020 wraps up, it's not only going to accelerate people moving to Bend, but there's going to be a fair amount of people that have been in Bend a long time. They're ready to move out. They're ready to downsize, whatnot. And this is a perfect opportunity for them. So I'm optimistic that as 2021 rolls around, this inventory crisis is going to be mitigated a little bit as we see additional homes coming on the market of people making life changes, taking advantage of some of the equity that they now have built in into their homes. What we do know, and we can finish it on this, is I honestly believe that the business synergy of Bend is going to be more sticky than other lifestyle towns that have received the new citizens. Right. So I kind of imagine Bend as, those, I'm not sure if it shows that I've lived in the West too long, those fences along some of the highways that are those deer escapes. So the deer can slide through one way, but can't come back. Or like those turnstiles at an amusement park, you can go out, but you can't come back in. I feel Bend is a little bit like that in the sense that a lot of people fled the cities, and whether they're in a cabin in Idaho or whatnot, have kind of used this year as a little bit of a sabbatical. But as they need to get back to work, as business needs more interaction, as they want to scratch that entrepreneurial itch and start a business again, can they do that? And I think that Bend is a lot more, it is a lot more friendly to those types of people. And it has the venture capital, and it has the business entrepreneurial environment, and an amazing chamber of commerce and development council, all those things that have got us to the point where we're leading the nation in job growth for small metro areas. I think that it's going to be a little bit more of a one-way gate than a lot of the other towns that got to push people over the last 6 months. Another thing that we know that's simply not going away is that we have a critical housing shortage here in Bend. And the mortgage rates that we're seeing are simply going to add to that buyer demand. I want to do another one of these webinars in the near future about housing and housing shortages. I spent about an hour and a half today talking to the long-term planning manager of Bend about the shortage of housing. And we're just so different than we were 12 years ago, where frankly, we kind of had a surplus of housing. We had a rampant speculation. We had 3,000 to 4,000 homes being built every year. We had 10,000 platted lots out ahead of us, et cetera, in a time where when it shut off, then a cascade. We're very different right now. We virtually have no vacancy in our rental market. And the calculations that we were doing today is that we're short about 1,800 homes a year, not total, 1,800 homes a year, both for the last couple of years and looking forward for the next 20. So when I see that type of housing shortage, I have a hard time imagining a scenario where we get oversupplied, which is to go back to it, supply and demand are really the primary drivers of housing market. When I see a critically low supply of housing, it certainly puts a lot of arrows in one direction when I try to think of kind of what's the long-term future of this asset class being housing here in Bend. And then the final thing that what we do know is that the current economic outlook is strong overall. Granted, there's some weak parts of the sector. There's a lot of small businesses that are barely struggling to hang on right now. And as a community, we need to continue to rally behind them to help them. But the bigger picture of where we stand as a city and a nation in the coming years is extremely strong. From our university to our business environment on through, it's a pretty strong, robust, rosy picture that we have out ahead of us. So, from that conversation that I was having with Brian Rankin this morning, he's an absolute genius when it comes to this. And I think that anyone that is unaware of the planning that goes on with the city of Bend, I think we all need to come together, and if we ever meet those planners, thank them. We have a lot of challenges, and I think it's a lot easy for a lot of us, especially in industry, to point fingers at the city and say, if it wasn't for these Oregon land use laws, if it wasn't for the urban growth boundary, we'd have more housing, it would be more affordable, et cetera. I honestly just don't believe that's the case. They are meeting the demands of what we're doing with grace and better than most cities that I know of. When you go to, we're going to all have growth. All these beautiful cities that we want to live in have growth. It's how do you do it and how do you react to it and what do you make of it? And there's a lot of towns out there that I think are really missing this opportunity, and they're not creating the planning and growth, the infrastructure that'll make the town even better in the future. And I was just I was typing as fast as I could when I was speaking with him this morning, because this quote that he said that seared into me. And he said, Brian, with this demand, we have so many opportunities. Bend is paying attention to the broad strokes of urban planning. And with that, we can create so many great things, like complete communities that are within walking distance to parks and jobs and services. And while Bend is an awesome place to live, we want to make it even more awesome in the future for all Bend and, for all citizens and parts of Bend. And this is coming from the long range planning manager for the city of Bend. And so we're not without our challenges. And, it has been an absolutely wild year here in Bend. And frankly, I'm ready to kind of put a bow on this year, or tape that box closed and put it in the closet and not come back to it. But I feel strong about our industry, and I look forward to discussing this with any of you one-on-one. We'll, you know how to get a hold of us, but more importantly, if you wish to engage and learn a little bit more about what's happening in our economy, I encourage you to join this Impact Conference that we have with the Chamber of Commerce next week. We'll put the notes here wherever we post this. And I'll leave it at that. So thank you for joining me today. Everyone, have a great Friday, have a great weekend, and I look forward to catching up in the near future. Meg, I just heard you pop on. Were there any questions that I could answer?
Yeah, you have a couple questions. There's one in the chat and one in the Q&A there.
Okay, let me pull up the Q&A. It's okay. It says for Gerard, it says those in Bend selling their existing homes are doing what? Are they reinvesting in another home in Bend or moving elsewhere? And there's another question. So that's a really good question. And there's a lot of head scratching. And it's one of the reasons, Gerard, that we have a lack of inventory of homes to sell, because there's a lot of people that want to sell and they're not sure where to go. They're trying to figure out what to do, because if they want to stay in this market, it's very competitive for them to buy another house. So what we're finding is people that absolutely want to make the move and stay in that market, they're having to sell their house, move into a rental to buy another. And that's very disruptive to a lot of people. So that's one of the main challenges. So I think the majority of the homes that we're seeing come on are either selling to leave the market. Unfortunately, they're going to, use this Bend money and go elsewhere, or they're going to build a future house. So what was incredible about 2020 is that land sales were up 300%, which meant there was a lot of people that couldn't quite find the home that they wanted. So what they did is they sold their house, bought a lot as kind of the placeholder, moved into a rental, and then they're going to build their house in the coming years. The other thing that I saw people do, and we've been able to successfully negotiate for a lot of our sellers, is negotiate a leaseback. So sellers are in charge right now. So we had several people put their home on the market and said, I'm going to sell it, but I'm going to require a 3 or 6 or 9 month lease back. So what was happening is, because there's also a lot of people that want to buy a house here, but they don't need to move here right away. So you can put your house on the market stating that, hey, I'll sell it, but I want a lease back. So you close the house, you get the money, and you become a tenant in your own house while you look for that other house. And that's been a nice kind of a grace period that we've been able to negotiate for a lot of our buyers, or sellers. The other question that you had here is, and who are buying the homes of people in San Francisco, Portland, Seattle, and who are they? Good question. So what we're seeing is that a lot of the people that first came in kind of round one COVID were renters. So the biggest effect that we've seen in those urban centers are rent prices going down. So I was speaking with an agent in San Francisco a couple weeks ago, and he said San Francisco rentals are down 2020. They have 20% vacancy and 20% decrease in rental prices. So I think a lot of those people that were first coming here were renters. Now the true case is, the people that have to sell to move here. What we're finding is that those urban centers, it's not all doom and gloom. It's very defined to the downtown urban cores, and it's usually in condo product. So it's a very narrow asset class that's really being crushed right now in those urban centers. And if you get outside of that core, even a half mile, the markets are doing fairly well. And anyone selling in the suburbs of those big urban areas are still doing quite well, because there's plenty of people wanting to be part of that. And I'm also seeing it kind of plateau in some of those urban markets. And we are starting to see here in November some sales trending, even on the condo product. So there's that. Hopefully that was helpful. And Meg, you said, so we had Q&A. Where's the chat? I've got a lot of things open here. Okay. Have you seen any difference in the housing market since the election, or is it still tuned to tell if it's a positive, negative? Good question. So I've looked back at the data. Housing, what I found, doesn't care about the president. And as much as we want to, in our mind, politicize housing and president, it really doesn't make a difference. What the housing and all markets don't like is insecurity. So what we did see is a couple weeks leading up to the election, a slight pause, especially the week leading up to it, and it has since resumed again. So we're off to the races again. I don't think the president, everyone has their personal affiliations, but I think the market doesn't really care. And it's another one of those things that I think in the market, it's easy for us to lack that cognitive dissonance to separate ourselves from our beliefs. I had a really sharp investment advisor in town tell me a month ago that if Biden was elected president, the stock market would crash, and it hasn't done that. Now, obviously, it's a little more nuanced with a Republican Senate and all that. But all I want to get at is that I think we can get too close to our political beliefs and portray that on the market. So I don't think the president, whether whoever is going to be president, has much of an effect on housing, but we are back and going again. Let me see here. We have one more question, it looks like from John. Is the market likely to keep up its current pace and prices through the holidays? Another awesome question. So traditionally what we see is a pretty seasonal market, especially in Bend. It's kind of a March, April, May, June, July, and start tailing off August, September, and very quiet October, November, December, January, February. This year has rewritten all the rules. What we're finding is that kids aren't in school, people are working remote, and we didn't see that slowdown at the end of this year. And so what we're also predicting is an increased selling season through the winter and the holidays at above normal rates, just because we have such a lack of inventory and still buyer demand. So good question. We're seeing a lot that we don't normally see here at the end of the year. But anyways, Meg, is that all we've got at this point?
I think that's it.
Wonderful. Well, hey, if anyone wants to get a hold of us, look us up, send us a note. Thank you for joining. I really appreciate it. And go to that Impact Conference. That one's going to be a lot of fun. Take care. Have a great day.